Last night, Google made the biggest profit any Google has ever made, $112 billion. I was in a single quarter, and then its stock fell. A few minutes later, Tesla reported a record number of cars sold. Its stock fell too. Same night. Two giants. Two great headlines, two falling stocks. Here's the uncomfortable part. Most of Google's record profit wasn't real, not illegal, just not real. And by the end of this video, you'll spot the exact same trick on any earnings report, using the two numbers the pros check before they even read the headline. And this matters to you even if you don't own a single share of either one. These two earnings reports are a masterclass in how a headline number can tell you the exact opposite of the truth. Learn to read them properly, and no company, why not Google, not Tesla, not even your own bank, can fool you with a big shiny number again. So, let me walk you through Wednesday night, because it might be the cleanest example you'll ever see of Wall Street fooling everyone with a number that's completely true. Start with that headline. Google's parent company, Alphabet, reported net income of $112 billion. Net income is just the formal word for profit. What's left after all the bills? A year ago, that number was $28 billion. So profit didn't just grow, it roughly quadrupled. Sounds amazing. But there's a problem. $99 billion of it came from a single line called gains on equity securities. Translation: Alphabet owns pieces of other companies. This quarter, those pieces went EP in value on paper. So Alphabet added that increase to its profit, even though it didn't sell a thing. Nobody wrote them a check. No cash arrived. Accountants call this an unrealized gain. Think of it like this. Say you bought a house years ago, and this year its estimated value jumps $100,000. On paper, you're richer, but until you actually sell, you can't spend a single dollar of it. That's unrealized. And most of Google's gain, reporters traced back to one stake in particular, its slice of Elon Musk's rocket company, SpaceX. Here's the timing that matters. SpaceX had gone public just weeks before Google's quarter closed, and its shares had jumped. So Alphabet got to reprice its stake at that new higher market value and book the increase as profit. But it hasn't sold a single share. That's what makes it unrealized. It's real only as long as the stock stays high, and a position that big is its own trap. Try to actually sell it and you'd flood the market and push the price down, losing a chunk of the value on the way out. $99 billion on the screen, a lot less in the bank. Strip that gain out, and real profit was closer to $35 billion. Still a solid quarter, but not a record and not quadruple anything. That famous headline number, earnings of $9.11 a share, drops to under $3 once you remove the paper gain. Same company, same quarter. Two completely different stories depending on which number you choose to trust. But if the quarter was still fine, why did the stock fall? This is the part most people miss. The pros didn't stop at profit, they jumped straight to a number called free cash flow. The actual cash left over after a company runs itself and pays for its big investments. Profit can be dressed up with accounting, cash can't. You either have it or you don't, and that's exactly why the pros trust it more than profit. It's the hardest number to fake. Google's free cash flow last quarter was negative, minus $5.9 billion. So on the very night it announced a record profit, real money was flowing out the door. Where did it go? Into building AI. Alphabet spent almost $45 billion in 3 months on data centers and chips, and she roughly double a year earlier. And it warned investors that for the full year that spending is climbing to around $200 billion. One analyst said it plainly. $200 billion he called the do not cross line, and his words, you can't be offloading this much cash and not talk about it. That's the real story of Google's night. A record profit on paper, cash pouring out the back, and a spending bill that keeps growing. Now here's where it flips, because Tesla did the exact opposite and still got punished. Tesla's headline looked like a miss. Its adjusted profit came in at 33 cents a share when Wall Street wanted 50. On the surface, bad quarter, but look one line up. Tesla sold a record 480,000 cars, up 25%. Revenue beat expectations. The business is clearly growing. So why did profit look weak? Same force as Google, just reversed. Google's paper gain made an ordinary quarter look spectacular. Tesla's spending made a strong quarter look weak, because Tesla is pouring money, more than $25 billion this year, into humanoid robots, self-driving taxis, and AI data centers. Elon Musk flat out called it a massive CapEx year. CapEx just means big, long-term spending, factories, machines, computing power. That spending hits today's profit line as a cost. The payoff, if it ever comes, is years away. So Tesla's earnings today get squeezed, even as the rest of the business grows. And it really is growing. Its self-driving software passed roughly 1.5 million paying subscribers, up more than 50% in a year. Its energy storage business grew even faster. Its robo-taxis are already carrying passengers in cities like Austin, Miami, and Tampa. By almost every measure except the one everybody looks at first, this quarter's profit, Tesla had a strong 3 months. The spending is simply eating the number on the front page. Step back, and the thread tying both companies together is obvious. Two of the biggest names in tech, 2 headline beats, 2 falling stocks. Why? Because the market quietly flipped a switch. For 2 years, investors cheered every dollar spent on artificial intelligence. Spending meant ambition, and ambition meant a higher stock price. This week felt different. Now they're treating that spending like a bill that's come due, and they want to know exactly when it pays off. Honestly, this shift deserves your attention more than any single number in this video. It isn't about one bad quarter. It's a change of mood across the whole market. Google and Tesla just happen to be the 2 loudest examples on one Wednesday night. And think about what that means for every other tech giant lining up to report. The bar just moved. It's no longer enough to say you're building the future, now you have to show the money coming back, which leaves the real question hiding underneath all of this. Everyone is spending fortunes on AI. Who can actually afford it? Google is spending from strength. Its old, boring search business, plus a cloud division that grew 82%, throws off real operating profit it can pour into data centers. Tesla is spending more on a promise. Robots and robo-taxis that mostly don't earn money yet. Neither is clearly right or wrong, but that's the lens that cuts through the noise. When everyone bets the farm on the same trend, the survivor usually isn't the boldest spender. It's the one whose existing business can quietly pay the bill. So here's the one line worth screenshotting. On any earnings day, ignore the headline profit. Check 2 things. Is the profit real or a one-time paper gain? And is the company actually generating cash or burning it? Google's record was mostly an illusion. Tesla's miss was hiding a record. Same trick that 2 directions. Learn to read those 2 numbers and no big headline can fool you again. And that's the whole point of this channel. Understanding money so nobody can play you with a scary or shiny number. If this was useful, you should watch this video next. And if any term here still feels fuzzy, free cash flow, unrealized gains, CapEx, drop it in the comments and I'll make a dedicated explainer. One real question for you. What's a record profit you've seen that turned out to be an accounting mirage? Tell me below. I read them, and they become future videos.